Hi everyone, Maria Tyler here again. In today's video we're going to cover the ratios that you have to do as part of your assessment too. Now the first part I'm going to go through the theory behind it, and then the second part I'm going to go through the actual calculation of the ratios and also analysing them. For the theory component, I'm going to go back a couple of years to a previous lecture and I'm going to play you my previous lecture's theory component because I think I did a pretty good job and I don't think I can top it. And then I'll be back after that to take you through calculating and analysing the ratios with this year's financials of Wesfarmers. So ratio analysis hopefully will provide us with a little bit more insight into the business just by using its financial statement. And we do this because we're trying to figure out or glean mathematical relationships between the financial statement figures. So it is mathematical, it's a calculative analysis, and we use the financial statement data, so it's using the historical data, and hopefully we're trying to identify, we're just comparing one figure to another. We call that a mathematical relationship. So for example, the very first ratio that we'll look at is called the net profit margin. We're simply comparing net profit to sales and looking at the relationship between those two figures from the income statement. So for every dollar of sales, how much are we turning into net profit? So that's the net profit margin. So ideally you want a higher net profit margin because you want to be turning most of your dollar into net profit. Unfortunately, in the real world, it doesn't work that way. So, but we're just looking at the relationships. Now, we do group them into three main areas. So we have profitability ratios designed to show us how profitable or to give us indications of how profitable a business might be. We have liquidity and efficiency showing us how liquid or can they pay their short-term debts and how efficient are they using their assets. So liquidity and efficiency ratios give us indications of those. And long-term solvency or gearing, which is how have we structured or financed the structure of our company. So have we predominantly used outside or external debt, or have we funded it through owners' share issues and so forth. So long-term solvency is the third main group. In our particular unit, we separate them into original or general ratios, and then of course we have our specific restated ratios from which we'll use the restated financial statement data. So in this unit, the ratios that we will actually use, we won't use all the ratios that I'm going to go through, but I find that they're quite useful and I'd like to go through more than just what we use in this unit, just to give you a bit more of a complete picture. It's by no means comprehensive. There are a lot more ratios out there, and you can even make up your own ratios as well, because really a ratio is just expressing a mathematical relationship between two figures or two or more figures. So in this unit, I've highlighted the names of those ratios in red, just to give you an idea of that's what's going to be in your spreadsheet. So in general, so these are the general ratios. I'm going through the general ratios first, and then I'll go through our restated ratios at the end. So the general ratios, which we'll be using our original financial statement data for, starts with the profit margin, which I explained before. It's for every dollar of sales, how much are we turning into net profit? And return on assets is very similar. For every dollar of assets, how much are we turning into net profit? So what return are we gaining for investing our money into the assets of this business? So again, with these two figures, you do want to see it higher. Higher is more favourable. Return on equity, same concept again. What return are we getting for the equity that we're putting into this business? So again, you do want to see a higher figure. Now, we don't calculate this particular ratio in this unit, but we do calculate this in the restated ratio. So I'll cover that when we go down, but the concept is the same. Okay, continuing on with profitability ratios. These profitability ratios are more to do with shareholder returns, so we call them market ratios. So earnings per share, now your companies actually calculate this for you, but we don't want you to use the company's calculated one because they tend to round their number of shares. They show you their calculation anyway. It will be slightly different to the one that you calculate, and we want to see your calculation because that shows your understanding of it. But essentially this is for every dollar that we've put in, for every share, how much have we earned for that share? So if I own one of the shares in Wesfarmers, how much has that share earned for me this financial period? So it divides our total profit by the total number of shares issued. So total profit that Wesfarmers has been able to generate for this financial period divided by, or spread across, if you like, the total number of shares on issue. So every single shareholder, if Wesfarmers was to distribute all of the profit to all of its shareholders, how much would every single share earn? How much would everyone get? So that's earnings per share, and that's actually a very commonly quoted figure in the financial press. So earnings per share, and it's also part of why it's included, because it is so commonly used. It's automatically included, or the companies have to calculate it and include it on their income statement. So you would have noticed it. We didn't enter it into our financials, so that was the section I said just ignore, don't enter that in, because for our unit we want to calculate that ourselves. We don't want you to use the one that your companies have already calculated. So if this is how much the company could have paid out per share, then why didn't they pay this amount out per share? This is what this tells us. So dividends per share is how much the company actually paid out of the earnings. So let's just assume, say earnings per share was $1.50 per share. So for every share on issue, they could have been paid $1.50 as a return, but the company may only have paid out 50 cents per share. So they're actually retaining some of the earnings and not distributing it as dividends, because they want to invest in the assets in the future, or the company's operations. So companies, it's very common to have a larger figure for earnings per share and a very small figure for dividends per share. Now, Wesfarmers actually pays out a significant amount of dividends, and you'll find that larger established companies do that. Startup companies or smaller companies, or companies that haven't been operating for that long and don't have quite a strong asset base yet, they generally won't pay any or very large dividends. They will pay smaller dividends, if any dividends at all. And of course, if the company is making a loss, i.e. they have negative earnings per share, they won't be paying any out in dividends. So I think Virgin Blue for a number of years, Virgin Australia now, for a number of years they were making a loss, and they did not pay any dividends. So earnings per share is the earnings per share, so profit divided by number of ordinary shares. The dividends per share is dividends that were paid divided by number of ordinary shares. So how much they earned per share, how much they actually paid back to the shareholders per share. Price earnings ratio, now this means different things to different people. Actually, all the ratios could mean different things to different people. I'm just explaining my view of them. But price earnings ratio is a bit of an interesting one, because I used to explain it as, I see it as a measure of inflation of a share. So when I'm doing my own investing or looking at companies in terms of for my super fund, I don't like to see a higher price earnings ratio. I prefer lower price earnings ratio, because if I see a higher one, to me it's more inflated. Now, a manager, one of my students I was teaching the MBA to a number of years ago, he said he prefers a higher price earnings ratio, because he looks at price earnings ratio in terms of expectation about future profitability. So if he sees a higher price earnings ratio, to him that means, well, people must be expecting good things of this company, or the market price wouldn't be so high in relation to its earnings. So he prefers a higher price earnings ratio, and it does encompass all of that. So price earnings ratio is really a comparison, as the name suggests, of the market price to the earnings of that company. So that's why it's called the price to earnings ratio, price earnings ratio, or PE ratio that we commonly call in practice. So it literally takes the market price of the share and divides it by the earnings per share, this figure up here. Now, one of my students, I was explaining that every year I explain it like that. One of my students a number of years ago said to me, "You just confused me with your explanation. It's really simple." Price earnings ratio to him, when he looked at comparing the market price to its earnings, he said, the price earnings ratio simply tells you how long you're going to be paid back for your investment. So he says, for example, if I invested $5 into this share and it paid me $1 back every year, then it would take me 5 years to be paid back for my investment in that share. And I thought, actually, that's a really good way of explaining it. So have a look at the mathematical relationships between these figures and make sense of it for yourself. That's what we're asking you to do in your assignment. So I'm going through and I'm telling you my understanding of these ratios, but you might find an easier or more basic or novel way of explaining it so that others can understand. And that's what we're looking for. So for that student explaining it in that way, that was a spot on way to explain it. That would have, for me, that was a 5 out of 5 explanation. So, so price earnings ratio really just compares market price to the earnings of that investment. And however you want to interpret that, I'm looking forward to reading in your assignments. But essentially that's it. So price earnings ratio is a measure of inflation, how inflated a share is. It's also a measure of how long the share is going to take to pay you back based on these earnings per share. This denominator here, the bottom figure, is actually this ratio that we've calculated. Dividend yield is sort of like your term deposit interest rate. So it's what dividends you did get paid back for your share divided by the market price, divided by the investment amount. So it's like I said, like your term deposit. If you think about it in conceptually, it's the interest you earned on your term deposit divided by your term deposit investment amount. That'll give you the percentage interest rate. Dividend yields the same things. The dividends you got paid divided by the investment amount, which is the market price for that share that yielded the dividend amount. So it's a percentage. So again, the dividend yields is the dividend rate that was paid back to you for your investment. So it's your investment rate. So again, you do want to see this higher. It generally isn't very high because companies, like I said, prefer to retain their earnings rather than distributing it back out to shareholders. So dividend yields, think about it in terms of interest rate, return on assets, return on investment. Dividend payout simply compares these two figures to each other. So it says how much, well, what percentage did they actually pay out of what they could have. So this is potential 100% what could be paid out. How much did they actually pay out? So if you actually divided these two figures together, you would get the same figure as the dividend payout figure anyway. And if you look at it mathematically, the ordinary dividends is already here as the numerator, and the net profit after tax minus preference dividends is the numerator here. And again, that just shows one divided by the other. So the dividend payout compares what could have been paid out with what actually was paid out. So we only look at the first three for this unit, or we only calculate the first three for your firms in this unit. So that's profitability ratio. So the previous slide where we went through the general profitability ratios, we look at these two in this unit, and the shareholder and market profitability ratios, we only look at the first three in this unit. Okay, moving on to the next group, which is our liquidity and efficiency. So liquidity looks at, can we pay our short-term debts? Do we have enough cash and short-term assets to pay our short-term liabilities, our immediate liabilities? That's liquidity. And efficiency is how efficiently are we using our assets? Are we overworking them or are we underworking them? So obviously we want the nice balance, equilibrium in the middle where we're not overworking them, we're not underworking them, but we're using them at the most efficient point as possible, you know, economics and where the lines meet. So we're using them at equilibrium they're most efficient. So first of all, liquidity. So current ratio tests liquidity, and it simply compares current assets to current liabilities. So for every dollar of current liabilities, how many dollars of assets do we have to pay? So at least you'd want to see 1-to-1, at least with current ratio. You want to see at least, if you've got $1 of liabilities to pay, you want to at least have $1 of assets, current assets, to pay that with. And it's interesting to note actually with ABC Learning Centres a number of years ago, their current ratio was manipulated to show that they had enough current assets by reclassifying some non-currents to current. So they wanted to show that they had enough current assets to pay their current liabilities. This current ratio is commonly linked in real life to a lot of loans, particularly business loans. So a business, especially new startup business, that the bank might say, well, we actually require, before we say you must pay us this money back, before they start foreclosing, we require a certain current ratio, say 2-to-1. So for every $1 of current liabilities, we require you to maintain at least $2 of current assets. So this is a really important ratio that's used in practice. You'll probably come across this if you work in the banking finance sector in the future. So we do calculate this in this unit. It's in red. The quick or acid test ratio is more of a stringent test than the current ratio. Essentially, it's the same thing. It measures for every $1 of liabilities, how many cash assets do we have? So it says, okay, let's take our more stringent current assets. Let's not include all current assets. Let's include just cash and short-term money market equivalents of cash and accounts receivable. So assuming that we can call up our customers that owe us money and actually ask them to pay that cash, which is also questionable. But anyway, the quick or acid test ratio just takes more stringent current assets and divides it by our current liabilities. So again, another measure of short-term liquidity. Our receivables and inventory turnover and assets turnover, this is measures of efficiency. So how efficiently are we collecting money from our customers? How efficiently are we selling our inventory? And how efficiently are we utilizing our assets to generate as profit? So essentially that's what these measure will give us an insight to. So receivables turnover tells us how quickly we are receiving our money for making our credit sales. So we obviously sell to credit, to our customers on credit, we let them pay later. So it compares our net sales revenue with the average amount that's outstanding for these customers to pay us back, our credit customers. So how quickly are we turning over our receivables? How quickly are we collecting our money? And you can make that into a number of days figure by dividing 365 days by the receivables turnover figure. That will tell you how, on average, how long it's taken you to collect your money from your customers. Inventory turnover, same concept. How quickly are we selling our inventory? So from the point where we actually purchase our inventory to the point where we actually turn it into a cost of sales, where we actually sell it, how long is that period? So again, the inventory turnover figure simply states how often we are turning over our inventory into sales, and that, again, you can see that in the mathematical formula. If you divide the inventory turnover figure into 365, you'll get this figure, days inventory, and that's what we actually calculate. So we do the average inventory, average daily cost of sales, this is where we put the 365 in, and I'll show you how to do that when we actually go through our company spreadsheets. So number of days inventory, how long is it taking us to sell our inventory from the time we purchase it to the time that we actually sell it? The asset turnover is a measure of how efficiently we are utilizing our assets to generate sales. So how often are we turning the value of our assets, of our average total assets, into sales? How often are we turning that dollar figure over into sales? So again, with all of these, you generally do want to see a quicker figure because a quicker figure means, with the receivables turnover means that you're collecting your cash quicker from your customers. With the inventory turnover, it means that you are selling your inventory faster. And with the asset turnover, it means that you are using your assets to generate sales faster, or a lot more sales. So generally you do want to see high figures, but you don't want them to be too high, because if it's too high, for example, you might be overworking your assets, and that's not sustainable, and that could lead to longer or larger costs in the long term. So you don't want to be overworking your assets, you just want to be working them sustainably. So yes, we'd like to see larger figures, quicker figures, so bigger figures here, which means more faster turnover, but not too fast. And we should always be benchmarking against industry. So that's liquidity and efficiency. So the first two on liquidity and the last four on efficiency. Now in this unit, we only do the current ratio for liquidity and the last two for efficiency. The last group of ratios that I'll cover is the financial stability or solvency or long-term financial structure ratio. So how have we geared our company? Have we predominantly funded our assets with debt or external borrowings, or have we predominantly funded it with owner-generated funds such as shares? So with long-term stability, we calculate a debt and an equity ratio, which simply measures what proportion of your assets are funded by debt or equity. So both of these ratios should add up to 100%. Because if it's not funded by debt, it's got to be funded by equity, or vice versa. So for example, if you have a debt ratio of 40%, your equity ratio will be 60%. So you can see your total assets is both a denominator figure here, the bottom figure, and then on the numerator, the top figure, it's liabilities or debt and equity. And again, if you think about your balance sheet equation, assets equals liabilities and equity, you can see that whole picture of the pie together in these two ratios. So debt ratio plus equity ratio always has to add up to 1 or 100%. The debt equity ratio is different to each of these. It compares one to the other. So the debt ratio, debt ratio is this one, the equity ratio is this one. The debt equity ratio takes those two and compares them to each other. So divides one by the other. So if we continue our example of 40% here and 60% here, if you divided the 40% by 60%, you would get 0.67, which means for every dollar of equity, 67 cents is being put in to fund the assets of the business by an external party, such as a bank. So it compares, the debt equity ratio compares the debt to the equity component. So it says for every dollar of equity, how much is being put in by a debt, external debt, or the bank, or some other external financing. So debt equity ratio is different to these two. That's very important. A lot of people think they're the same. They're not. Times interest earned is simply how many times does our profit cover our finance costs, essentially. So we use earnings before interest and tax rather than net profit after tax, because again, for management purposes, interest is a financing function and taxation is generally out of the manager's control. So they use profit before interest and tax usually. So earnings before interest and tax divided by all of our finance costs. Finance cost expense and finance cost capitalised, because sometimes companies capitalise for accounting reasons, finance costs on the balance sheet. So finance costs on the income statement and finance costs on the balance sheet, add them together, that's all of our finance costs all together. How many times does our profit cover this figure? So again, you want that to be higher, because that means you've got a higher profit to cover your earnings. And again, if you find that your company doesn't even generate enough profit to cover your interest costs, they've got problems. They're probably too heavily geared, too much in debt, and that can be a problem with long-term solvency. They may not be able to pay their debts as they fall due, and the company may actually have to be wound up or closed. So times interest earned is a pretty important long-term financial stability indicator. Now in this unit, we only calculate the equity ratio and the debt equity ratio. So that's our general ratios. Now I'll just cover our restated ratios. So there's only 6 of them, 6 restated ratios. And again, they're pretty much the same concept to what we've covered already. And you can actually, in your assignments, I expect you to compare one with the other, because that's the whole point of restating. Our original financials were how our companies presented them, and our restated financials are restated in terms of operating and financing. So the ratios I've just been through are based on our original financials, and the ratios I'm about to go through now are based on our restated financials. So we should be able to see the difference between the same ratios using different financial statement figures, and hopefully glean some further insights from that. So again, our return on equity I covered up above in our profitability ratios on the first slide. So it's this one. So we don't calculate this one in this unit, but we do calculate it for the restated ratios. So we use comprehensive income and average ordinary equity. So CI, this is what we put in brackets, and that's why I said you can see a lot of the acronyms on this slide. And when we were entering and restating, doing our restated financials, I said make sure you put in brackets your acronyms, because it will be so much easier when you come to calculate these ratios. Just looking at this acronym, oh, I need OI here, so click into the OI cell, wherever you've put OI, click into the NOA, click into your RNOA, your NFE for your net financial expenses, and so forth when we go through on the next slide. So hopefully you've used your acronyms. It'll make life a lot easier. So return on equity, how much return are you generating for your shareholders? So we're looking at comprehensive income, dividing it by the average ordinary equity. So again, you want to see a higher figure here. Higher figure is more favourable. Return on net operating assets is same as return on assets that we looked at in the profitability ratios on the first slide. So return on assets, again, looking at the return for the use of your assets. So how much of for every dollar of assets, how much are you generating in profit? And that's the same concept with our restated return on net operating assets. How much are we generating, how much profit or operating income are we generating from our operating assets? So again, you want to see a high figure. And talk about the comparisons, because you calculate both of those. So you calculate the return on assets using your original financial statement figures, so you'll get a percentage figure there. And then you also calculate the RNOA, or the return on net operating assets, using your restated figures. So compare them. Is one higher than the other, and why? Look at the inputs. So we calculate RNOA here. Profit margin, again, we've looked at that in the first slide. So we use the operating income divided by our sales for our restated ratios. Originally on our general financial statements, we looked at that here. It's again our profit divided by our sales, but from our original financial statement figures. So for every dollar of sales, how much are you turning into profit? And we calculate that for the original financials. We also calculate that for the restated financials here. So you should be able to compare one to the other. Is one higher than the other? Why? Look at what have we done between the original and the restated? We've separated into operating and financing. So we've left out the financing items. So has that made a difference to the profit? Is our profit margin higher from our operational assets? So this is all very interesting. You can have a look at your firm and see what further insights you can glean. Now, economic profit I haven't covered yet, but in the study guide, it is covered in a lot of detail. And if you've studied economics already as part of your degree, or if you've done any other studies into economics, you'll have an understanding of this. But essentially, economic profit covers opportunity cost. And opportunity cost is the cost of the next best alternative. So what you would have been able to put your money into if you hadn't gone with your current decision. So it looks at making a profit to not only cover the funds invested into this particular decision, but also to cover the cost of not investing in your next best alternative. So we call that opportunity cost. So economic profit takes into account the cost of capital, so that opportunity cost. And you can see it factored into the equation here actually. RNOA, which is our return on assets, that's RNOA. And you have to explain that as part of your assignment and into its drivers, but more about that later. So RNOA, take away, so this is a percentage figure, or can be a percentage figure, take away your weighted average cost of capital, so I call it a WACC. Your weighted average cost of capital is the very commonly used acronym in the real world. And again, companies actually have a set WACC usually. So the study guide tells you can actually just use 10% for this, but I would encourage you to have a look at your company's annual reports and just see if they have their own WACC that they use, their weighted average cost of capital. And if they do, use that instead and write about it to your marker, so your marker knows that you've actually taken an understanding of the weighted average cost of capital and had a look and found it, that your company uses it. Now, sometimes a company won't tell you, or they'll say, look, we do use the weighted average cost of capital, but they don't list it. In that case, just use 10%. 10% is the easy option. And so we say, okay, so this is the return that our operating assets is generating us. Take into account, so take away the cost of capital. So that's the extra profit that we're generating over and above our cost of capital. And then multiply that percentage figure by your net operating assets to get our economic profit, just to make it into a dollar value, essentially. So this is percentage, this is dealing with decimal points and percentages. So our return that we're generating, take away our cost of capital, so covering our opportunity cost. This is the amount of return or profit that we're generating greater than our opportunity cost or our cost of capital. So this is the profit over and above it. And then turn that into a dollar figure by multiplying it by your net operating assets from your restated balance sheet. I left the divided by 1 there because I couldn't format out this line. So divided by 1 is just leave it as the top line. So if you've got negative or a very small return on net operating assets, i.e. less than your weighted average cost of capital, so you might have a negative percentage figure here or a negative decimal figure here, then of course your dollar figure is also going to be negative. And that's fine, because you know that you expect it to be, because you've got a very small return or a negative return here if you've actually got a loss instead of operating income or profit. So always explain and analyze your figures looking at your inputs, because what might be for one company might not be for another. Then one company might have a profit, one company might have a loss, and so forth. Okay, so that's economic profit. That's our profitability ratios for our restated financials. Now we'll just have a look at a ratio under financial stability and one under efficiency for our restated ratio. So you only have to do six ratios for your restated financials. So we have a look under financial stability at net borrowing cost, which again is, think about it in terms of your interest rate on your loan. So when you go out to get a home loan, they say, okay, we'll lend you this money and we're going to charge you an interest rate on your home loan of 7%. Okay, so this is what this calculates it. It calculates your your interest rate, if you like. We call it the net borrowing cost. So it says, what's your finance costs after tax? And what was your total borrowings, your net financial obligations, so NFO from your restated balance sheet. So this was our net finance costs after tax, and this is divided by, so we're saying how much interest have we paid, how much did we borrow. So essentially it gives us an interest rate. And then that would be really interesting to compare to your firm's loan rates, because some firms in their financial statements will actually disclose how much they're paying in interest on their loans, on their long-term borrowings in their notes. So you can actually say, well, I've calculated their net borrowing cost at 6%, but they're actually paying 7% on their loan. So actually this is really good. They're not paying as high. Essentially on their financial statements, their net borrowing cost isn't as high as their loan cost. Or you might find that their net borrowing cost is a lot higher than the interest on their loan. So it's not a true indication. So the 7% interest is not a true indication of all of the costs of that borrowing or of that debt. So again, this can be quite interesting, but that's what it calculates. And under efficiency, how efficiently are they using their assets? Same concept as what I explained under the efficiency ratios for the general. On the second slide, I think it was. Yeah, so this one. So the asset turnover, how efficiently are we utilizing our assets, using our general financials? So the same concept under the restated, we're simply using sales and our net operating assets. So we're leaving out the financing assets from here. So how efficiently are we using our operating assets to generate sales? For every dollar of operating assets, how much are we generating in sales? How often are we turning over the dollar value of our operating assets into sales? So again, you want to see a higher figure. You don't want to see it too high because that might mean that we are overworking our assets. So compare this figure to your asset turnover that you calculate for your general or original financial statements and see, is there any difference? And if so, explain it. And that's what we're looking for in your assignment. So that's pretty much all of the ratios. I know that was a little bit dry, but hopefully that's given you a bit to talk about in your Word documents when you actually have to go through and explain all of your company's ratios. Please use your own words, so understand each one and then explain it in your own words. There's a number of limitations of ratio analysis. It is performed on historical data. It's not used on forecasted data. We use it as a measurement base. Year-end data might not be representative of what actually happened during the period, because the balance sheet only shows a snapshot as at one point in time. There is a general lack of disclosure in our general purpose financial reports, and again, you'll probably find that when you're going to look through for prices such as your market price and figures, such as your market price and so forth. So there is a general lack of disclosure. There could be some one-off or non-recurring items that's skewing your figures. This is actually a really important one. In 1 year, there may have been, for example, discontinued operations, which made a huge loss. And so when you calculate your ratios for all 4 years, you'll see nice profits. And then that 1 year will be this huge negative figure. And you'll be like, what did I do wrong? You go back and have a look. And that'll be that one-off, non-recurring, hopefully non-recurring item that has skewed your figures. So when you're explaining that, write about that in your assignment. Say, well, it's actually huge and negative because they had discontinued operation in that year. They realised it was making a loss, and so they got rid of it. And so that's why there was a huge loss in that year. And then the next year they generated a profit or whatever it is. But just make sure that you are, if there is 1 year that looks funny, 1 or 2 years, investigate why. So ratios are just little red flags that indicate something might need investigating. So just because we look at it and we say, oh, well, this is good or this is bad, it's not necessarily the case. It's just an indication saying you might need to investigate to see if it is good or if it's bad. And of course, some entities just may not be comparable. They're in different industries, different economic climates and so forth. So there are a number of limitations, but generally it is useful. And if you just realise that ratio analysis simply shows you mathematically a relationship between two figures on the financials, then hopefully that will help you in your understanding of what you can use it for, and you don't apply it to outside its scope, essentially. Okay, so tips for us when we complete our assessment, the ratios component. There's a few preparation items that I would like you to do to make life easier when you're actually calculating the ratios. Identify the number of issued ordinary shares. Usually you can find this in your PDF annual reports. Identify the market price of your shares. Sometimes your companies will disclose this in their annual reports, sometimes they won't. If they don't, you need to go onto a main website, so any sort of finance or stock exchange website, so for example the Australian Stock Exchange, or Yahoo Finance or Google Finance, because they all list market prices of shares, and usually you can type a date in of a company on those finance sites, and they will actually show you the share price as at that date. So if your company doesn't tell you in your annual report, then you may have to look elsewhere for the market price of shares, but identify this first. And also identify your cost of capital. Don't spend too much time on this. Just have a quick search through your company's PDF documents. If you can't find it, just use the 10% suggested in the study guide. But do state that you have had a look so your marker knows that you were a bit proactive and tried to find your company's weighted average cost of capital. Your ratios must be fully linked. Do not type anything into your ratios other than a formula. And I'll show you as we're going through how we can put these in a little working section down the bottom and link to those as well. So if you've accidentally made a boo-boo with one of these, you can correct it down here and it will flow through everywhere you've linked that above. So make sure that it is fully linked. All your ratios need to link to the original financials except for your restated ratios, which should be linked to your restated financials. So all of these ratios need to be linked to your financial statements tab, your original financials, and then all of these ratios need to be linked to your restated financials tab. So make sure that you are linking the whole lot to the correct set of financial statements. Okay, so now we're going to complete the linking. So take the time to pause the video and go and get your PDF reports, get your completed company spreadsheet up to your restated income statements. So you should have completed all your restating. Use your completed company spreadsheets. Go and get your annual reports, because we'll need to look through those for number of ordinary shares, market price and cost of capital. And make sure you've got access to the internet to search out market prices of shares if your company doesn't tell you what those are in the actual annual reports. All right, so pause the video now, go and get those and come back and we'll do the ratios. Okay, so before we actually start linking our ratios and calculating and analysing them, we've got to identify three things, okay? So first one is the number of issued ordinary shares. Now we're looking for the number or the quantity of these, not the dollar value. The dollar value is actually in our balance sheet and also in the statement of changes in equity. We don't want the dollar value. We want the actual number of shares that they've got on issue. The other thing we want is the market price of shares. Now, this is normally in your annual report somewhere. If not, usually in the note, well, it has to be in one of the notes to the financials. So you should be able to find this one inside your annual report somewhere. The market price of the shares, though, you may not. A lot of companies do disclose their market price in their annual reports, but if they don't, some companies don't, you will have to go searching online for their share price. Now, sometimes you can find it on like a general site like Yahoo Finance or Google Finance, but if not, go to the stock exchange that your company is listed on. So in my case, Wesfarmers is listed on the Australian Stock Exchange. So go to that stock exchange website and put in your company's stock exchange code, or look up your company by its name on their website. And they usually will have information on your company, not just about the share price, about a number of different other items and issues as well. But one of the things they will report in is your company share price. And sometimes you have to pull up a little graph for a certain time period and then follow it along till you get to the balance date for each year. And sometimes the graphs aren't even very accurate, and so you just have to look and sort of get an approximation. But as you are doing that, I would encourage you to take screenshots and include all of your research into your Word document as to why you are using the market price that you are using. So we just want you to make sense and make meaning of this for yourself, really. That's the point of doing it. It's not really to calculate the ratios, it's actually so that you get familiar with these terms. And also, calculating the ratios, you can see how we can have some tools to analyse financial statements. And the third thing we have to identify is the cost of capital. I'll go through that soon. So let's search our annual reports, our financial reports, for the number of issued ordinary shares. So first things first. So I'm going to go to my 2019 annual report, straight to the balance sheet for equity. We scroll down till we get to the section on equity and just see if they have, hang on, here it is. So just see if they have listed something that says, ordinary shares, issued capital, something similar that indicates that the shareholders are earnings. So in my case, Wesfarmers is calling it issued capital, and go to that note. That would be my first advice. Go there first. So I'm going to go to note 12 and have a look and see if it tells me the number. So I want the dollar value, but I also want, I need to know the dollar value in my financials, but I also want to know the number on issue. And the first thing I want to point out about this, so here it is, they actually do tell me the number. Look, they've got ordinary shares in numbers as well as dollar values. So they've got the quantity and they've also got the price or the value. Now, look at the way that they've expressed these numbers, and this is very important. It's something that I didn't cover in the previous videos. I'm going to point out now. When you entered your financial statements, right at the beginning, Martin, in his introductory video, so I'm on getting started, tells you how to customize this. So you put the name and the balance date in. But he also tells you to have a look at the denomination of your financial statements. And you can easily find that by going to your annual reports, your financial statements, and have a look at what they're actually denominated in. So any of the financial statements will tell you what they're listing the numbers in. Wesfarmers' case, they're listing their figures in millions of dollars. So I can read this figure as 1.013 billion or $1,013 million. Okay, so we know that they're expressing their figures in millions of Australian dollars. We just want to reflect that in our spreadsheet. It's very important, so I'm just going to change that. It's not thousands. You only have to change it in that one cell, G6, because then everything, Martin has automatically linked the template. So everything everywhere else will now be updated and changed. It's a wonderful thing about linking and why we harp on about it so much in this unit. Okay, so make sure that your figures, that you're reflecting the correct way or how your figures are denominated, because when we come to entering the number of ordinary shares, we want it to be expressed in the same way. Now, Wesfarmers, I'll go back to the 2019 report, hasn't expressed it in millions of dollars. Even though they've expressed the dollar value, the number of ordinary shares is expressed in thousands, which means when I enter this into my spreadsheet in the preparation section below, I'm going to have to convert it to millions of dollars because I want it expressed in the same denomination as my figure. So when I come to do the ratios, I don't have to think about it. I can simply just click in and link it. So I'm pretty lucky I found my number of ordinary shares fairly straight away in the note. If you can't, you will have to search through your documents. I would search for something, key terms, ordinary shares, have a look and see if that produces anything. Number of shares, number shares. If not, have a scroll through. Somewhere it will tell you. It usually is. It's very rare that I have not. In fact, I don't think I've ever seen a company that hasn't listed the number of ordinary shares that they have on issue. They normally have it somewhere. Some companies actually put it in the financial statements, in the actual equity item. But most companies will put it in the notes like Wesfarmers has done. Okay, so I'm going to go and enter these in now for 2018 and 2019. So this was my balance at the end of the period in 2018, and this was the balance at the end of the period in 2019. So I'm going to go and convert that. You'll notice they are exactly the same. So as at the 30th of June for 2019, I need to convert that to I need to convert 3 decimal places back because I need to convert from thousands to millions, and a million is 1,000 times 1,000. So 3 zeros in 1,000, so 3 decimal places backwards. So I'll enter 1133.84. And again for 2018, I will also enter 1133.84 because I want to express it in millions of dollars. So let's go on and set that up. Right at the bottom of the ratios tab, we'll go down. Let's link the years first. And let's call this one number of issued ordinary shares. Actually, you know what I could have linked to? Let's link straight here. Just link your years so it looks nice. And I'm going to format them the same way too. So format painter and okay. So number of issued ordinary shares, and I know it was 1133.84 in both of those years, 1133.84. Now I'm going to just format these all as a number. Oops, let's go and do that again. 1133.84. Okay, now I'm going to go to my 2017 report and see. So again, issued capital is in note 12, so I just have to go down to note 12. And here it is. All right, so let me have a look. So again, they're expressing it in thousands, so I'm going to have to convert this one. So same balance again in 2017, 1133.84. 2016, we had a different balance. So 1126.131. 1126.131. All right. So that's my number of ordinary shares. So I've already identified that, so I can tick that one. Moving on to the market price of the shares. So my first point of call, you could just go straight to the stock exchange website. But some companies, a lot of companies will list their market price per share in the actual annual report as well. So I'm going to do a quick search and I'm going to put market price and just see if that, and just have a look through. No. Okay, so let me type in share price and have a look and see. Okay, so now they've got a few share prices in here, so I've got to read a little bit and make sense of them first. This looks like there's additional info on an award scheme, so you have a look at what you're looking at and where it is in the context of the annual report. It's not what I want. It's to do with a long-term incentive plan for obviously their key executives, so I don't want that. I want the actual share price for the shareholders. So equity settled awards, I'm not interested in that either. Their keep, again, the executive remuneration, not interested with. So it doesn't look like share prices can be accessed from, here's that stock exchange. So I could go straight there. I'll just keep looking because in previous years, it usually actually lists them. Yeah, here we go. So Wesfarmers, like, this is part of their remuneration report. They actually like to disclose their share price amongst a lot of other key figures that they've calculated. So they list me in a nice, neat line in amongst all the other key indicators, which I'm not interested in at the moment. I just want to look at the share price. So I'm just taking these figures in this line for 2016 and 2017. Okay, so in dollars as at 30th of June. So I want to enter them in dollars at this stage. When I'll explain more about looking whether we enter them in dollars or cents when we talk about where we use them in the ratios. So in this case, I'm going to put $40.10 and $40.12 into my two figures here, 40.10 and 40.12, and we don't want them as percentages, we want this as dollar figures. Okay, so this is my market price per share. Now, again, if I was lucky to find it in the annual report, if your company doesn't, go straight to the stock exchange site where they're listed on, and you'll be able to search, and you might have to spend a bit of time, pull out the information, have a look at the reports. Some stock exchanges will give you an option to click onto share price as at certain date. So you will need to do a little bit of searching. So what did I find it under? Ordinary shares. No. Share price, I think I searched in 2017. Here we go. Straight to it when I put that search term in. So you might have to try a few different search terms as well. So closing share price as at 30 June. Oh, look, I could have just used this report and got all four of them and not had to go through the other one if I'd just done that. There was my $40.10 and $40.12 for 2016 and 2017. So I'm just going to enter in 2018 and 2019. So 49.36 and 36.16. 36.16. Taking a bit of a hit in the market price per share. Okay, so I've identified the market price of Wesfarmers shares. The third thing I have to do in preparation for my ratios is to identify my cost of capital. Now, cost of capital is usually companies will express a cost of capital somewhere in their annual report. It's the cost of their capital funds that they're using to fund the entity. So capital funds come from debt funders and equity funders. And most companies will disclose something called a weighted average cost of capital, or a WACC, W-A-C-C, which is basically a weighted average of the amount of debt that they hold and the cost of that, and the amount of equity that they're using to fund the business, and the cost of issuing those shares and other equity funds. So they will add them together, the proportions of equity, we hold the cost of that, the proportion of debt, we hold the cost of those funds, and then they'll add them together, and that's what they call the weighted average cost of capital. So if you can search your company's annual reports for a weighted average cost of capital, you can use that. See if they actually, no, nothing, they don't use the acronym. Let's call weighted average cost of capital and see what comes up with that. So Wesfarmers actually does have a weighted average cost of capital because they use it, but they don't disclose it anywhere. Well, not in the 2019. Let's have a look and see in the 2017 annual report. So again, they don't disclose it there. So the assignment document tells you to use 10%. If you can't find your company's weighted average cost of capital, just use 10%. So in this case, I am going to use 10%. So I'm going to convert this to percentage and put 10 in there. If you find your company's cost of capital, just enter it in here and write about in your Word document why you're using a different figure than 10%, and they'll be fine. And you can say, I found it on page 57 of the annual report. They actually use a weighted average cost of capital in their capital investments and so forth. And so we're happy for you to do that. They're the three things I had to identify. So now I can start going through it and linking my ratios. So we'll do the original financials, and then the restated ratios we'll link through to the restated tab. So we'll start up the top here. So for the net profit margin, our numerator is net profit after tax. Now, there are a number of different net profits in the income statement that you can choose to use. And if you choose to use a certain one, just state why. So I like to use the very final net profit. That's my total CI. So I'm going to actually link to, in the income statements, this very, very bottom figure here, total comprehensive income. That's going to be the profit figure, net profit figure after tax that I use. But if you would like to use the net profit after tax, so this particular line here for me in Wesfarmers, profit attributable to the members of the parent after tax, after all their discontinued operations, you can use that one and just write about why. So some companies actually put a profit after tax before discontinued operations. There might be another profit total here which you can use, and that's also fine. In my case, I like to use the very, very final profit. So that's the one I'm going to do, divided by our sales. Now, some of your companies will actually list out a sales figure in the revenue section of your income statements. Wesfarmers doesn't for me. I separated out the finance income, so I'm just going to link to this revenue item here. If you chose to link to total revenue, that's fine also. You would just write about why. You might like to include all of the revenue. I'm going to separate out the F in this case. I'm just going to leave it out and link to the revenue. So hit enter and drag it across. Okay, so this ratio tells me out of every dollar of sales, I've turned 20 cents into net profit after tax. And the trend is improving. So in 2016, I didn't really turn anything into sales. It was very small. In 2017, I turned 4 cents so every dollar of sales I turned into 4 cents of net profit. 2018, it was 5 cents. In 2019, it's greatly improved to 20 cents per dollar of sale. So let's go and have a look at the return on assets. So same numerator, net profit after tax, as the one that you chose to link to for the previous ratio. But this time I'm going to divide it by my total assets figure in the balance sheet. So here's my total assets in the balance sheet. And again, that tells me for every dollar of assets, how much am I turning into net profit. So I turned 1 cent in 2016 right up to 30 cents in 2019. So the trend is improving. Okay, it's done a huge jump in this year, and I know they had huge changes to the company structure in this year, so it's obviously affected their profitability in a positive manner in 2018 to 2019, getting rid of some of those discontinued operations, and it's because they actually made a profit on those discontinued operations, and we could see that when we entered the income statement that we had a number of different profit items. So that's why there's such a big jump there. So when you're interpreting the ratios, make sure that you're interpreting it in the light of the story that these are telling about your company. Now, down to the efficiency ratios, the days of inventory, a little bit about this one. Some of your companies won't have inventory, okay? If they're a service company, they predominantly provide services to customers rather than selling goods to them or goods or products, then it's most likely that your company won't have inventory, in which case you can't calculate the ratio. So just write that in your Word document, and also write here, I would write your marker a little line stating that your company doesn't have inventory. But just make sure you check properly, because if your marker finds that your company has inventory, they will mark you down for not calculating it. So make sure you check properly. This is why it pays to know your company. I know very well that Wesfarmers has inventory, so I'm going to go straight to the current assets on the balance sheet and link to inventory. Okay, now divided by the average daily cost of goods sold. Now in this next unit, you will learn about how when we purchase inventory, we plop it on the balance sheet until such time as it's sold. Then we do a journal entry, we take it off the balance sheet and plop it onto the income statement. When we put it to the income statement, we call it cost of goods sold. When your companies report that though, they don't have to use that term cost of goods sold, and most of them don't. Wesfarmers doesn't. So you have to know your firm and be able to look through its expenses and and identify what is the most likely expense to be their cost of sales. Okay, it's that inventory item that they've sold and moved the cost figure to the profit and loss statement. And because we want the average daily amount of it, we will divide that by 365 days. So I would suggest when you do that, put that little calculation in brackets. Otherwise, Excel will not calculate it properly for you. So let's go and do it for Wesfarmers. Going to equals inventory divided by the average daily cost of goods sold. So inventory is straight on my balance sheet under current assets. So here it is, inventories divided by, open bracket, because we have to do the average daily of cost of goods sold. I'm going to go and look for cost of goods sold under my expenses. Now, Wesfarmers doesn't call it cost of goods sold. There are a number of different names that your companies can call inventory when it's been transferred to the income statement. Common ones are raw materials and inventory, which is what Wesfarmers has done. Cost of sales, cost of goods sold. Sometimes they won't even be listed under the expenses. They'll be listed under the revenue items as a negative revenue, under what we call a trading statement. So you may have to explore your financials a little bit and read about in the notes about what each of these are if they're not straightforward. Wesfarmers easily tells me this is their raw materials and inventory that's been transferred onto their profit and loss statement. So this is the figure I need. And I'm going to divide that by 365 days. Close bracket, enter, and then drag that across. Now I need this as a number, not a ratio. And it's come up as a negative. The only reason it's come up as a negative is I'm actually linking to a negative figure, okay? It doesn't mean anything. It's simply the way I've entered my expenses in. In this case, some ratios, the negative does matter. So you need to be able to interpret each ratio because you understand it. In this case, it doesn't. All I'm calculating is the number of days it's taking me to sell my inventory, essentially. So to negate that, I'm going to put a little negative sign in front. I don't want to see a negative for this. It doesn't tell me anything about the ratio. And generally, I want to see a smaller figure here, okay, because it means I'm turning my inventory over in a quicker time period. So in 2016, it was taking me on average about 50 days between the time I bought and sold inventory or created inventory and sold it. And over time, I've actually increased that. I'm taking a bit of a longer time to sell my goods to my customers. It's almost at 90 days now. So the trend is not good. But if you look at the 2-year trend, it is good, because we were on par for about 2016, 2017. Then something happened in 2018 and they went totally out of whack. But now they're reining it in. They might have some tighter inventory management policies, and they're actually reducing. So it's over the 4 years, it's increased, which is not good, but over the 2-year outlook, it's decreased, which is where we want to head it. Now, having said that, you want a shorter inventory turnover. So that means you're selling your inventory quicker, and so getting money and so forth. But you don't want it to be too short, because if you've got a really quick inventory turnover, it means that you're selling inventory so quick you might actually be missing out on sales because you're having stock outs. So you're not stocking enough and you're missing those sales. So you do want a small figure, but not too small. You need to benchmark it against your industry. Okay, so that's days of inventory. Next one is the asset turnover ratio, and it's sales divided by total assets. Now, again, you can use any item of revenue. If your company actually lists sales, I would suggest to use that one. In my case, I'm going to do revenue divided by total assets. So revenue divided by my total assets on the balance sheet, and it's telling me for every dollar of total assets, how much am I generating in sales? So I want a higher figure, essentially. The $1.61, for every dollar of assets, I was turning it into $1.61 of sales, fairly on par in 2017. I knew in 2018 it might have been a little bit down because, we weren't really managing our inventory very well. And so hence you can see that we've also weren't managing our assets very well either. We weren't being very efficient with our assets in 2018. Of course, we made a few major changes in 2018 in Wesfarmers, and they've managed to regain that back to fairly near where it was 4 years ago. So over the period, it has slightly decreased, but it's trending this on par with itself. So at this stage, no real insights for me. Liquidity ratios. Your current ratio looks at, can you pay your debts if they were to fall immediately. So we just look at current assets and current liabilities, because that's the short-term assets and the short-term liabilities. So that's all on the balance sheet, equals current assets divided by current liabilities. And again, you'd want at least a 1-to-1 ratio, because it means for every dollar of liabilities that I have to pay, do I at least have a dollar of assets to pay it with? So I did in 2019. For every dollar of current liabilities I had to pay, I had $1.22 of current assets to pay it. But over the last 3 years, not good. Haven't even had 1-to-1. Haven't even had a dollar of current assets to pay a dollar of current liabilities. So over the trend is increasing, which is a positive thing in terms of liquidity. Okay, Martin often says the only way a company can go bust is to run out of cash, and this is a good indicator of whether that may be a problem. In which case, Wesfarmers is slightly improving, but they have also always generally tended to have a fairly low current ratio. Some banks will actually stipulate on a bank loan that a company has to maintain a current ratio of a certain amount, and if they fall below that, they request repayment. So a lot of companies will look at this ratio in a lot of depth. Okay, financial structure ratios. How are we funding our entity? The first one we look at is the debt equity ratio, which again looks at for every dollar of shareholders that they put into the company, how much has an outsider put into the company, and it's literally debt we call our liability, so total liabilities divided by total equity. So on the balance sheet, total liabilities divided by total equity. So for every dollar of equity that the shareholders have essentially put into Wesfarmers has borrowed from the bank 83.9 cents. Okay, so that's fairly high. They're increasing that trend as well. If you look, there was 77.7 in 2016, and they've increased that. So debt equity compares debt to equity, as the name suggests. The equity ratio simply tells you what percentage of the company is funded by the owners. And you can actually compare that to the percentage of a company that is funded by the banks, which is literally the sum addition of that. So if we were to do the equity ratio, what percentage of the business is funded by the owners? So equity, total equity divided by total assets. Total equity divided by total assets on the balance sheet. So 54%. So it's fairly on par. It was 56.3 in 2016. They slightly increased it and then repaid. Sorry, not repaid. This is equity we're talking about, not debt. So shareholders were funding 56.3% of the company back in 2016. They're funding slightly less of it now, which means they're funding it slightly more with debt in 2019. So if we go and do the debt ratio, which is debt divided by total assets, you don't have to do this one. I'm just doing it to help you understand it. So total liabilities divided by total assets, okay? If you add both of these up, oops, hang on, equals this plus this, you should get 100%, because that's 100% of your company's funding represented by your shareholders, your owners, and represented by the banks or your debt holders. Okay, so in 2019, the owners had funded 54% of the Wesfarmers, and the banks had funded 45.61%, so slightly increasing their bank borrowings and slightly decreasing the amount funded by owners. Now I'll just highlight this one in yellow. You don't have to do this one. This is, I just wanted to illustrate the difference when you're trying to explain it. The debt equity ratio literally is the debt ratio divided by the equity ratio. So if you were to do that, you would still get 83.9%. So debt equity ratio compares one to the other. The equity ratio tells you percentage of the total assets that are funded by equity, and debt ratio tells you percentage of total assets that are actually funded by an outsider, so a bank most likely. And if you add the debt plus the equity, you should get back to 100%. Okay, so it looks like Wesfarmers has been fairly consistent on those fronts anyway. Now we get to the market ratios. Now earnings per share, your company actually already calculates for you in its income statement. So if we went back and had a look at the income statements for Wesfarmers, you would see that right down the bottom, this is the 2019 one, that they actually already calculate an earnings per share. And they have the basic earnings per share and the diluted earnings per share, and that was one of the key concepts we presented in the lectures early on. So again, basic earnings per share is your profit divided by all of the ordinary shares on issue. But those ordinary shares on issue sometimes have rights to issue more shares. So as a shareholder, you might have a right or an option or a warrant on it that says at a certain point in time, you can exercise to create more shares. And if you exercise that option, then more shares are created, which means there's a larger denominator to spread your profit over, so it dilutes everybody else's earnings, hence why they're called diluted earnings per share. So your company already calculates it and they express it in cents. They do a weighted average of the shareholding, because shares are traded every day. So they do a weighted average of the denominator, the number of shares on issue every day, and then they divide that by the profit. We don't worry about that. We just take the figure as at one day in time. So we just look at the number of ordinary issued shares as at the end of the balance date of your company. And we've already done the hard work. We have expressed it in the same manner as our company's denomination figures. So in Wesfarmers' case, that was millions of dollars. And this is why we've done it, because look, now I don't have to do anything. I can simply click into that figure. The net profit after tax is already expressed in millions, and I have already expressed my number of issued ordinary shares in millions. My dividends are expressed in millions in my financials. My number of issued ordinary shares, I have also expressed in millions. I can interpret it in the same manner. So net profit after tax equals that same net profit that I linked to right at the beginning of my first ratio, this one here, divided by my number of issued ordinary shares for that year, which is down here. Hit enter, which is great. Okay, so this is my calculated earnings per share every year based on the shareholding as at balance date. It's not a weighted average. You might like to compare these figures to the ones that your company has calculated and see what's going on. For me, I'm going to look at the trend as well. So I'm going to say my earnings per share has increased. That's a really high one for Wesfarmers. I've never seen it like that for a long time. But it's in line with its profitability. See that big jump in profitability? The market ratios, obviously the share price, so obviously the earnings per share has also improved because look at the numerator. They're exactly the same. So if we're linking to the same figure, the net profit has increased. So if we're linking to that same figure, we would expect those ratios to trend in the same way. Okay, so I can see there's a big jump again between 2018 and 2019. Let's have a look at the dividends. So dividends per share is, so the difference between these. Earnings per share is, that's how much, if a company like Wesfarmers was to pay out all of its profit to its shareholders, this is how much every shareholder could get per share that they earned. These are the earnings per share of the company. So $4.83 in 2019. A company doesn't usually pay out very much, though, of these earnings to its shareholders, and that's what your dividends per share tells you. So out of the potential to pay, how much did it actually pay? Wesfarmers is actually, because it's such a long-established company, it actually pays really huge dividends, and it does it consistently, keep its shareholders happy. A lot of your companies won't. They'll probably pay cents per share in dividends, not dollars like Wesfarmers does. But go and have a look. Your dividends are found in your statement of changes in equity. So dividends, go right up to your statement of changes in equity. It's under the transactions with shareholders and usually towards the end somewhere. So mine are called equity dividends. So I'm going to link to that and divide it by my number of ordinary issued shares here. And again, we don't want the negative figure in there. The reason it's negative is just because I entered the dividends as negative. It was decreasing equity. It doesn't mean anything. So I'm just going to negate that by putting a little minus sign in front of it. Fill that formula across. So let's have a look. This is actually really large. Wesfarmers does pay out very large dividends. So in 2016, they earned 29 cents per share in profit. Yet they paid out $2.02 per share to their shareholders. That's very unusual for a company to earn so little and pay out so much. The more likely scenario is they earn $2.02 per share and they'll pay out 5 cents in dividends. So this is a very unlikely scenario. But Wesfarmers, if you look at the dividends per share, it's been fairly consistent. They've paid, generally around $2.02, $1.97, $2.23, and in 2019 they paid an even larger dividend. It was quite huge, to do with the demergers that they went through. So $3.20 per share. Okay, so if you have a look at every year, compare these two together, they earned that much, they actually paid out that much. They earned $2.55, they paid out $1.97 of that to the shareholders. They earned $1.19 in profit, they paid $2.23. Again, that's not usual to pay more than you've earned. It's usually you're paying a lot less. And in 2019, they earned $4.83 and they paid out $3.20 per share to their shareholders. So keeping their shareholders happy. So again, make sure that you are interpreting and analysing your ratios in context. Now, price earnings ratio. Market price per share, which we identified down here, divided by earnings per share, which is the figure we calculated in this ratio. So a very easy one to calculate. So market price per share divided by the earnings per share. Hit enter. Now, in the lecture, in the theory component that we had a look through, I didn't explain this very well. My student, if he was explaining it, he would say, okay, in 2016, if I was to buy a Wesfarmers share, it would take me 137 years to be paid back for that share, as opposed to in 2019, it would take me 7 years to be paid back for that share, okay, at current earnings rate. So in 2016, if you actually have a look, it's $40. And remember, we are looking at the denomination. So I've entered these as dollars. So my market price I entered as dollars per share, right? My earnings per share I'm also expressing as dollars. So I can divide dollars by dollars. If your company has expressed these as cents, you may need to change this to express it in cents, or alternatively change your market price to express it in dollars. Okay, but just make sure that whatever denomination you have expressed your market price in, that's the denomination that you're expressing your earnings per share in as well. Okay, so companies normally express these in cents, not dollars. I've expressed Wesfarmers as dollars in here. You'll notice they actually put cents. They express their calculated earnings per share in cents, which is fine. You can always convert it back. Just make sure when you're comparing that you're comparing apples with apples is what I'm trying to say. So looking at the trend, now is this a good trend or is this a bad trend? Well, it depends on the user of this information. So for me personally, as an investor, I like to see a smaller price earnings ratio simply because, like my student said, it means the share isn't that inflated. It means it's a shorter time to get paid back at current earnings. But managers and some investors like to see larger price earnings numbers because that a larger price earning number can indicate future profitability. So is it good or bad? It depends on the use for the information. Remember, ratios are just tools. It doesn't tell you whether something is wrong. It just, they're little red flags that say something may need further investigation. This may need you to take a closer look. Okay, so trending down. So for me, that means it, well, depending on your perspective again, it could mean there's anticipation of future losses following the demergers, particularly between the 2018 to the 2019 year, like such a huge difference. And again, we could see that in the share price as well. The share price took a bit of a plummet between the two balance states in those years. So there could be that expectation on the share market of potentially losing a lot of profit from selling off those operations, such as Coles. Anyway, so that's the price earnings ratio. Now, moving on to the restated ratios. All right, so far we've been linking to this tab, the original financial statements tab. For these particular ratios, we're going to link to the restated financial statements tab. So let's have a look. The first one is our return on equity. So it's our comprehensive income, our total CI divided by our shareholders' equity in the balance sheet. So equals our comprehensive income for the year divided by our equity in the balance sheet. So total equity is here. Enter. All right, so our return on equity is very high in 2019, and we thought that may be the case because, I mean, you know, it's had a higher profitability. Compare it to the trend over time, it has increased. Again, I would probably just be looking when I'm explaining this, particularly with Wesfarmers, because it has undergone such a huge transformation and selling off major businesses, major subsidiaries in 2019. I would actually interpret these ratios in light of those. Remember, I'm trying to tell my marker a story. So you need to delve into what these figures may be trying to add to that picture. All of these ratios are like little pieces in a puzzle. Everything that you do, that you've been working on with your company, is little pieces telling you this and that and the other. So, return on equity was 1.43% in 2016, but it's 54.88% in 2019. So a fairly huge return. If you think of putting your money into a company, how much, or into a bank for very ease of simplicity in explaining. If you put your money into a bank, you'd like to get a higher interest rate. It's the same thing with this ratio. So you want a higher return if you're going to put your money in a company. So if I got 1.43% as a return, that's pretty low. Like, why would you, for more risk? It's increasing to 12%. I'd be pretty happy with a 12% return. 5.92, not too bad. A fairly average return. If I got 54.88%, I'd be putting all my money in. Okay, so something's going on. So this is telling me I need to take a look. Why suddenly has it jumped right up when, in the previous years it was kind of a little bit mediocre, especially in 2016. And again, I know why, because I know what Wesfarmers has done, and it's offloaded a lot of its various subsidiary companies. Whether or not that's a good return for me, personally as an investor for Wesfarmers, I would then need to look at with my other goals. So this is one very small jigsaw puzzle. I wouldn't just go investing because it suddenly gave me a 54% return, because that's only just looking at the profit for this year. And the profit for this year included a large amount of profit from the sale of those companies, which doesn't reflect future profitability. So all those sorts of things. This is for the written component in your Word document you need to be thinking of. Okay, moving on. Return on net operating assets. Look at how easy this is going to be because of the acronyms. Remember in the previous videos I said when you're restating, put these acronyms in because it's going to make your life so much easier now. We just have to look for OI and divide it by NOA. So equals OI in the income statements. Where did I put OI? Here it is, OI, glaring out at me. Divided by NOA in the balance sheet. So scroll up to the balance sheet and find where you put NOA. Click in there. So good. So nice and easy. Drag it across. So for every dollar of net operating assets, how much have I turned into operating income? This one is very similar to, I'm going to put, so you remember to compare this when you're talking about it in your Word document. Compare it to your return on assets from the original financial statements that we calculated above. Remember in the restated financial statements, we separated O from F. So in these ratios, we have isolated the operating component, which is what's being reflected in these ratios. So this, compare it to when we didn't separate out operating in return on assets right up here. Okay, so this is our ROA. So compare this one with this one when you're talking about it in your Word document. So look at that from 2016, it indicated it had a return on assets of 1%. It was 1.94. Gives you a little bit more of an accurate reflection on the actual return on operations because we've isolated that out as part of our restating. So the trend should still be the same because it's still telling you the same thing. The only difference between this ratio and the one in row 9 is that you've isolated the operating, the O from the F in this. In this one, you've included the F as well. So when we actually isolate operations, we can see it's slightly better. And we have a better operating profitability. Right up to 62%, we also see that big jump again, but that operating income is due to the profit on sale of their discontinued operations. So I'm not too excited about that. Okay, net borrowing cost, again, so we're looking at the cost of the interest over the amount of debt we have, essentially. So we want to see a smaller rate or a cheaper borrowing cost, essentially. So again, I should get Mark to put these in. We should really just do this. NFE, okay, this is NFE divided by NFO. How easy is that going to be? Because I've actually put those acronyms in. So that equals NFE, my restated income statement. Where's my NFE? Here it is. Equals NFE divided by my NFO on the balance sheet. Here it is. Ta-da! So let's look at the cost of my borrowings. Now, if you've entered your expenses as a negative and you've also entered your liabilities as a negative, you can just leave it as is. Okay, if you've entered one as a negative and one as a positive, then you'll have to make sure that you're entering them the same way or that you put a little negative symbol at the start. They have to be entered the same way. If you entered this one as a positive, you need to look at whether this was a positive or a negative or not. So in my case, I entered my net financial expenses as a negative and my net financial obligations, I just show you, and my NFO, I entered as a positive, okay? So I'm happy that's how I want to enter them because you need to make sure that you're interpreting this in the right way. Now, let's just start with 2016. So in 2016, my net financial expenses after tax, okay, was, I'm going to show you the dollar figure because this one causes a lot of confusion because some students don't have NFE, they have NFI. So I'm going to spend a little bit of time on this one. I had net financial expenses of $230, okay? I don't need to know about the negative. What I want to get is a ratio component. So the negative doesn't mean anything to me. So I need to put in my calculator 230.1 and I'm just going to divide that by my actual number of obligations that I had. So I actually do have financial liabilities. I don't have net financial assets. I have net financial liabilities. So, and I know that because of the positive amount here. Here I have net financial assets. So I'm going to divide my 230.1 by my positive 5863. All right. So that makes sense to me because I'm actually dividing my interest, my finance expenses over my loans. So make sure that you can understand it. So I want to negate that negative. I don't need a negative figure in mine, and I do that by putting a minus sign in. Once you talk yourself through it in 1 year, simply fill it across, all right? So we don't need to worry about, we just know that that 1 year, once you understand the 1 year, you fill it across and then you'll be able to interpret your ratios accordingly. Look at it as a return, okay? So think again in term deposit land. If you put your money in the bank, you'd like to get more interest back from your money. So if you were to borrow from a bank, say to buy a loan or something, if you're putting your money in the bank, then you would like to pay less amount of interest. So you generally want a smaller interest rate on this figure. So for Wes farmers, if we're looking at this, they start off with 3.92% as a borrowing rate. So not too bad, but the trend is starting to increase, okay? So it goes to 5.34%, then up to 8.87%. And then in 2019, we get this negative figure. Now that's because simply I have turned it into net financial assets. So what I'm trying to compare in 2019 is a little bit silly and it doesn't make much sense for my company. So I'm trying to compare, so actually go and look at your figures. I'm trying to compare paying interest of 193.7, which is the difference between my finance cost for that year, my finance income, and taking away my tax benefit. So that's my interest costs. I'm trying to compare that figure to positive figures. So I actually had a large amount of financial assets in that year, okay, investments in associates and joint ventures. So I actually want to, and that was simply a reclassification of subsidiaries, because they demerged so much of their other operations. They actually included, instead of being a subsidiary, the amounts then get included on the balance sheet as investments in associates and joint ventures. So to me, that's not a real reflection of financial obligations. Well, they don't have any once that figure is included. So if I wanted to better reflect this figure, I could actually take out that large warped, skewed figure. Oh, hang on. I need to do it in this one. So open bracket, click into the total figure, and then take away this figure, because that's the figure that's kind of skewing my figures out. And then close bracket and enter. Negate the figure and then just tell your marker that, you know, we had large changes in the 2019 financial year, which has impacted on their net borrowing costs. I'm actually just going to interpret my ratio in light of the previous 3 years, which is fine too, okay? Tells us that you're thinking about what you can and putting a scope on it. All right, so 3.92 borrowing cost increasing to 8.87. To me, that doesn't bode too well, particularly when they are, well, actually, they were increasing the debt because I looked at it over the larger term. So if we just confine our thoughts to the previous 3 years, look at the trend for debt was 43%, and they're paying down debt, so they've reduced it to 38%, but they're increasing the borrowing cost on that. So what's happening here? Are they paying off more cheaper loans when they really should be paying off more expensive loans? Or are they actually, because they're paying off debt, is the interest rate increasing, or has it got nothing to do with that and it's to do with the actual market economy? So you could note all of these thoughts and reflections on that ratio in your Word document. Okay, moving on. Profit margin. Operating income divided by sales. So again, keep your operating income, OI, nice and straightforward. OI here, keep it handy. OI divided by, and scroll up to where you see sales. In my case, I'm going to link to revenue and drag that across. Now this one, you want to compare it to, so it's your profit margin with the operations isolated. So let's compare to the net profit margin. I'll just put NPM that we calculate. It's the very first one that we calculated, this one here. So our profitability is improving, but again, it's jumped because we had that large profit on the sale of all of those discontinued operations. Still though, over the 3 years, it's improving its profitability. When we isolate our operations, we get a true figure of the profitability. So looking at, again, an improving trend and a slightly higher trend when we isolate the operations out for profit margins. For every $1 of sales, we're turning 6 cents into operating income after tax in 2018. Okay, same with the asset turnover. Sales divided by NOA. So let's go sales on the income statement divided by NOA on the balance sheet here. So again, where's my sales? Why is that negative? It shouldn't be negative. Let's do it again. Equals sales on the income statement divided by net operating assets. That's a bit better. Don't know why it went negative. I must have pressed the negative button. Okay, so this is my asset turnover. So if you get a negative, you just want to negate the negative. It doesn't mean anything to us. And you want to compare this one compared to the total asset turnover that we calculated above, this one here. So again, asset turnover was relatively consistent over the 4 years. So in its efficiency, for every $1 of assets, they were turning $1.61 into sales in 2016, then $1.52 in 2019. When we isolate out the operations, it improves slightly. So for every $1 of assets, of operating assets in 2016, we were generating $2.29 of sales. For every $1 of operating assets in 2019, we were generating 3. So good trends, so improving trends, I should say. Okay, that's the restated ratios. Economic profit itself is a whole new baby. It's on its own league. If you look at the marking criteria, it's got its own marks just for its calculation. All of these other ratios are all lumped into calculation of ratios, and you just get 8 marks for general. Economic profit itself is 2 marks on its own. Okay, it has its own rating, and there's also a large number of marks for discussion on economic profit on its own. So pay some attention. The actual, the difference, or how you explain it, is in the formula. And we've already calculated R-NOA up here. Okay, so R-NOA is the one that you've calculated in your restated ratios. Cost of capital, we identified down here. If you found and used your company's weighted average cost of capital, this is where it'll come into play. If not, like me with Wes Marvers, just use 10%. That's what the assignment tells you to do. Multiplied, so this gives you a percentage figure. So if your return on your operating assets is greater than your cost of capital, you get a positive figure. And your net operating assets is from your balance sheet and your restated financials. And this gives you a dollar figure. So your percentage figure multiplied by your dollar figure will give you an overall dollar figure of economic profit. So if it's positive, it means your return is greater than the cost of capital. If it's negative, it means your cost of capital is greater than the return. So don't negate the negative sign in this one. It's important. So let's go and do open brackets equals open brackets R-NOA minus the cost of capital, close brackets, multiplied by your net operating assets on your restated balance sheet. And that's a dollar figure, so you might like to express it as dollar figures. Okay, so if there's a negative, it means that in those years we didn't have a return on net operating assets greater than our cost of capital. And you can see that, like in 2016 we had 1.94%, which is not 10%. So I knew I could predict it was going to be negative. In 2017 we actually had a small amount positive, so 11% over than 10%, which gave us 292.76 economic profit. Again, right up till we had a huge jump again in the 2019 year because of said selling of discontinued operations. So make sure you are analysing and talking about economic profit in terms of these drivers, and the assignment does talk about that. And again, you need to make sure the return, again, what's made up of a return. Martin discusses profit margin, asset turnover, impacting on the return on net operating assets, your weighted average cost of capital. So make sure that you are discussing all of those items as presented to you in the study guide in your Word document. So that's your ratios done. That's the calculation and also the analysis of it. Obviously, it's a very quick, a very basic overview. And that's sort of the level that we want you to get into. We want you to analyse them line by line, over a trend in time, compare the restated to the originals. And we also want you to do it in relation to the overall, the whole picture. What are these ratios telling you or telling me, or your marker or whoever you're trying to explain to, about Wesfarmers as a whole company? Okay, so it's good to talk about them as I have, but then bring it back into that overall larger picture as well. And that's it. So I'll see you for the next video.